Markets are continuing to listen to Jay Powell, the Federal Reserve Chairman, as he comes out strong and swinging at Jackson Hole. So the market has been digesting those remarks. And the word today out on the street is that interest rates are going to rise by 75 basis points again. A Wall Street Journal article leaked it out. Well, didn't really leak, but is talking about that 75 basis points is definitely most likely to occur at the next Fed meeting in a couple of weeks. The probability of a 3/4 point rate hike has moved to 82% on Wednesday morning, and traders ramped up their bets on Fed tightening. So the markets are now pricing in a 75-point rate hike coming at the next meeting. I do not think the Fed is going to back off of that. They have to continue with their messaging, and they have to continue to stand strong and fight inflation. And the reason is, like we've been talking about, markets are up a little bit right now. It's early. We'll see how they close. As I always say, you want to watch the momentum into the close. That kind of gives you an idea of how investors are positioning and what the real sentiment is out there. Markets were up yesterday by about 0.5% to 1%, and then ended up down about the same. So we'll take a look at the charts here in a second. But at the end of the day, the Fed has got to get inflation under control. And the reason is, like I've been saying, inflation is more damaging to the economy worldwide than what the Fed is doing and market valuations, things like that. And you can see, case in point, what's going on over in Europe with energy prices and commodity prices skyrocketing over there. A lot of businesses are now filing bankruptcy and having to close because they cannot stay in business with prices as high as they are. That's the kind of stuff that happens when you're in a deep inflationary environment. It puts so much pressure on businesses. They just have to close. They cannot continue to operate. And we haven't reached that point yet in the United States, but we're getting close with wage inflation, with commodity inflation, things like that. It's a lot of pressure on the services industry, restaurants, retail, things like that. Excuse me. My voice is still a little messed up. I'm recovering from COVID, so almost on the back end of it. But it hit my voice really, really hard all last week. So anyways, we'll continue to get through this. In other news, interest rates with bond rates up like they've been lately. We'll take a look at bonds right now. The U.S. 10-year has been over 3%, and the bond market has been on a tear along with the dollar. So that's putting pressure on mortgage rates back above 6% again. And as we know, that's a big, big threshold for housing. So we know mortgage applications are way, way down again. And home contracts, purchase contracts are getting canceled. People are not buying new houses. New construction builders are way down right now. And this is also a wealth destruction. This is what the Fed wants, right? They want housing to come down so people feel less wealthy. They want the markets to come down so people have, feel less wealthy and have less money to spend, driving the economy. And it's so far, everything's been kind of backfiring on the Fed because there was strong economic data. The job market is still strong. Economic data coming out lately is still strong. So the Fed has lots of work to do. They have lots of runway to work with, and that's what's going on with the markets. That's why we're seeing markets react like they are. Here's Bitcoin right here on the hourly over after its last drop yesterday and bottoming out at that 18.5 level, trying to make a little bit of a rebound here. Of course, there were a lot of people that were long coming into this move yesterday. I think it was over $1 billion worth of long interest, open interest, and very few people short. So that's a little bit of what's going on, a little bit of liquidations, but also just flat running out of steam. And as price stays below 20,000, now down in the 18,000 range. If it starts dropping down to the next level, that 17.5 to 18, which would be the next kind of level down like we've been watching here. If price continues to kind of follow that pattern, drop down to the next level and kind of consolidate in there for a while, that's going to trigger a lot of liquidations, a lot of margin calls, and some of the bigger holders that the space has been watching will come under pressure and have to sell some Bitcoin to cover some loans, things like that. The lower the price drops. The real question is how low it's going to get. And we've seen some technical confluence and been targeting some of those levels in the $15,500 range with percentages down, moving averages, things like that. There's a lot of technical confluence for that 14.5 to 15.5 level. And if that breaks or if it punches right through, then next stop's going to be around that $12,000 level. So the real question is, will Bitcoin be able to get that low with the interest in the space, interest in the asset? Now we know that institutions are looking at the space, preparing for their entry into the space. And with a risk-off environment going on right now, with the Fed raising interest rates, with recession fears and imminent concerns in Europe, and with recession concerns in the United States, these types of risk assets are not something that institutional investors are going to go into at scale. It's all about risk reward, and they're looking at where we're at right now. If Bitcoin were to drop 50% from here down to $10,000 level, that's a significant drawdown for an institutional investor, and it doesn't represent a very good risk reward profile for them. So they might dip their toe in a little bit, but they're not going to go in at any kind of a level until they know that the markets have settled, markets have bottomed, and we see if the June lows are going to hold for Bitcoin and traditional assets. Let's take a look at the Dow. And what's going on here is that major markets have now taken out critical levels here of technical support. This area here, and then this level here that has now been taken out in all of the indexes except the S&P is still kind of holding up at this level right here. Has found a little bit of support right there. So once those levels are taken out, the next stop is going to be the lows, and we'll see if there's going to be a bounce along the way, or if it's just going to punch right through those levels. And you can kind of see the patterns of how price has been working its way through on the way down, with this unwinding and deleveraging and repricing that the Fed has been broadcasting that it's looking for. And you're going to get these big bounces along the way. And we've looked at this in the past, in the history of these assets, and some of the bottoming structures out there, what that can potentially look like. And these things here are not typical bottoming structures. This is not a V bottom typical structure. This is the Fed coming in and pumping $2 trillion into the economy, moving interest rates to zero. Same thing happened here on this V bottom recovery. This was the Fed completely pivoting in 2018. And then when you go back to the 2008, 2009, with the unwinding that started, you had the banks collapsing, and then price kind of was working its bottom out to that final point. And again, this was a interjection by the Fed and the Treasury coming in, reducing interest rates, creating QE, and starting to pump liquidity in the markets that brought this out of a recovery. But even in this area here, where markets were kind of consolidating, trying to find a bottom before that final drop, and again, these were all bank failures that were going on, it still took about 6 months for the market to recover and get back to a little bit of a consolidation before it could take off. So this is potentially more of what a bottoming structure could potentially look like, where it kind of works its way, consolidates down to lower levels. You get one final little something can snap and just kind of create a little panic. But this was the Fed jumping in. So the real question is, what would have happened in these areas if the Fed had not jumped in to these assets? And if you take a look at Bitcoin, it's only been in existence since the Fed has been instituting QE, keeping interest rates low and things like that. And you can see with Bitcoin, traditionally it has that final drop to a more of a consolidation at the lows for several months, from November 2018 till April of 2019, 6 or 8 month period here, where price kind of consolidated on the lows before it took off, and then ultimately got derailed by the 2020 pandemic, when markets all sank. And then again, that's when the Fed jumped in and started pumping markets up. So the good news is there's a couple of recent instances in Bitcoin's history where we saw the ultimate lows in a panic situation in 2017, 2018, when the Fed pulled out, and in 2020, when the economy was falling off a cliff and the world was shutting down. Nobody knew what was going to happen. Bitcoin really 3,500 to 4,000 was the worst case scenario. So that most likely would hold in this scenario. There is a lot more adoption of Bitcoin and has been since then. A lot more people in the space, a lot more institutions in the space. So it would take a huge event for price to get below that. And it's going to take even a bigger event to even get it down to that 10,000 level or below. But this could be a long-term, drawn-out bottoming process before this asset can really recover, because so many people have lost so much. There's been so many liquidations. A lot of people are never going to come back to the space. A lot of people can't come back to the space. And it takes time to bring new capital into the space, which ultimately drives price. Doesn't matter whether it's Bitcoin or crypto, or if it's the stock market. It's the same premise, right? The stock market needs new capital to continue to drive the price up. The biggest buyer has been the Fed, pumping liquidity in the markets over the last couple of years. So it takes time for that to replace once it unwinds, and the unwinding has not stopped yet. So until the Fed stops, until inflation's under control, and until we have some sort of economic stability in the economy, globally and worldwide, we can't expect really for the markets to find a good footing and start to put that bottom in. Let's take a look at the dollar. Continues to work its way up. We'll see if it hits that $120 level, which was the high over here in the 2001, 2002 .com bubble. The dollar ended up at 120. So it's working its way back up to that level. We'll see if it makes it there. There's almost no technical resistance in the way. Oil has been dropping lately. I know a lot of people, a lot of analysts out there are calling, for $150 a barrel oil again. And we know this, the OPEC has cut production. They want the price back up above $90 a barrel. So we'll have to keep an eye on oil and see what happens there. And then, of course, we have the VIX. VIX is on the rise. And as we say, when the VIX is high, it's time to buy. When the VIX is low, look out below. So the VIX has been lower here and working its way back up, meaning markets will sell off when the VIX is at these higher levels. And you can see these peaks. This was March 2020. This was back in 2008 and 9. So you can see the events in history when the VIX, this is the 2000 .com bubble, was at its highest levels. That's typically when markets are reaching, those levels of lows where you want to buy. And then when it's low, that's when markets are peaking, and it might be a good time to get out and take some profits. So these are some of the indicators to kind of keep an eye on and look out for as the markets continue to work their way down. So the real question is this time different, and is the bottom in? So right now, you can't really expect from a probabilistic standpoint that the bottom is in. We're going to definitely going to test those lows. The most likelihood as the Fed continues to do their thing, especially if we get another strong inflation print coming out next week, that will give the Fed more resolve to be more restrictive in their policy. And we also have QT, which is starting, which means running off the balance sheet. And we're seeing all of these things reverberate around the economy. So things are getting tricky and dicey. And until we see some stability in a lot of these areas, especially on the geopolitical front and energy and things like that going into the fall and winter, it's going to continue to put pressure on economies around the world. So it's very tricky times to navigate right now. So you have to be defensive. It's all about preservation of capital, so you can take advantage of the opportunity when it comes around and the markets rebound and reverse and it's bull market back on. But this could be months to years. We don't know how long this is going to last. It depends on whether or not something breaks. The Fed's going to keep pushing until something does, meaning credit markets or financial markets. The question is, will they step in? Can they step in? And what will they do if we get another big event in the stock market? They're not real concerned about stock markets. They want to see them come down. They weren't happy about the rally that we had. They want to see housing prices come down, and they want the economy to cool off. So these are the things that I'm looking at. I'll see you on the next video.